So the purpose of this video is to address something that's been happening, and it's always brought up since I've started my career as a mortgage professional. And I wanted to address it in this video. And again, the purpose is just to give you guys the info that you need. So one thing that's always brought up and that's always catches people as a surprise is when their mortgage payment changes. And it's not necessarily just their principal and interest that changes, because that's locked in. Majority of first-time buyers or people who are buying a primary home to actually live in it, they have fixed rates and their principal and interest never changes. But one thing that gets promoted a lot that you'll see if you follow real estate agents or whoever it is that you follow, most people promote one of the benefits of owning a property as opposed to renting where you live is that your mortgage payment stays the same. As opposed with your rent, your landlord could just increase your payment whenever they see fit. And the truth is that that's not the truth. See, when you have a mortgage payment, your payment consists of principal, interest, taxes, and insurance. Sometimes an HOA, if you have to pay an HOA separately, but it's typically principal, interest, taxes, insurance, and if you're putting less than 20% down, mortgage insurance. So mortgage insurance and homeowners insurance, we'll just call that insurance. Principal, interest, taxes, and insurance. Now, the county that you live in might have something going on where they increase the taxes, or something might be happening with your homeowner's insurance that they increase your insurance. In these cases, these are called escrow accounts. In your mortgage payment, you have an escrow account. That escrow account manages the payment at the end of the year for your taxes and your homeowner's insurance, whether it be just homeowners and flood insurance. But in your breakdown of your monthly payment, principal, interest, taxes, and insurance, the taxes and insurance is called an escrow account. You can opt out of having your escrow account as a part of your monthly mortgage payment once you get about 20% equity, but most people pay the taxes and insurance with their mortgage payment. Whenever your county changes or increases your taxes, or your homeowner's insurance company increases your insurance, now your monthly mortgage payment changes because it's part of your monthly mortgage payment. So whenever your principal and interest doesn't change, but your escrow account, something's shifting in your escrow account, and that changes your monthly mortgage payment. Now, most people say your monthly mortgage payment doesn't change, but if you're escrowing, if you pay your taxes and insurance with your mortgage payment, it's a mortgage payment. That's part of your mortgage payment. You can't just send in half of your payment and say, hey, I paid my principal and interest, but if you're escrowing, I'm gonna pay that towards the end of the month. Now you have a late payment because it's part of your mortgage payment. It's not your principal and interest, but if you're escrowing, it's definitely a part of that. And that typically catches first-time buyers as a surprise because it's never spoken about, and they have this idea that if I own my property and it's on a fixed rate, that nothing is going to change with my mortgage payment. And that's something you should prepare for. That's why I always advise people, especially if you're in Florida, to file for homestead exemption and to keep your property up to par, just in case something changes with your homeowner's insurance. You can get another inspection done and hopefully shop for a new homeowner's insurance that's better for you and your monthly payment. But just always know that whenever there's a change with your county taxes for your property taxes and your homeowner's insurance, whether it's they increase your flood coverage or they increase just the overall coverage of the home, that's going to change your monthly payment. And most people get surprised from that. I get calls. I've always been getting calls. That's the reason for the video, is to address it. People would call me and say, hey, my mortgage payment went up. And it's most likely 99.9% of the time, it's because their escrow account changed, their taxes or their insurance. And truth be told, that's why sometimes most landlords who don't have like a huge portfolio and they just have like one extra home they're renting out, the reason why they increase your rent is because something changed with their escrow account. So in order for them to keep up with the mortgage payment, they put the increase onto you. Now, big investors who have like property managers, they'll increase your rent just to stay up to par with the rent market value and not miss out on any dollars. But majority of the time, for those other landlords who just have like a small portfolio, 1 or 2 properties, and they speak to you on a personal basis, they don't have a property manager or anything like that, they're increasing their rent because they received the notice that the taxes or insurance are changing on their property, and they have to prepare for that. So what happens exactly? The taxes and insurance, every time you make a mortgage payment, a part of your mortgage payment goes towards that escrow, which is the account that we were talking about, your taxes and insurance. Whenever you, let's say your total mortgage payment is $1,000, a part of that $1,000, let's say it's $300, goes towards that escrow. So it'll go principal and interest is $700, and the remainder is your escrow, which creates that total $1,000 payment. And you're making payments, and that escrow account is getting larger and larger every time you make a mortgage payment. At the end of the year, your lender goes into that escrow account and pays the county taxes and the homeowner's insurance. So you never have to do that. You never go out and speak to a homeowner's insurance company and say, hey, I'm ready to pay my premium. But what happens is, whenever they get notice of the increase, they start to prepare so that you're not short at the end of the year. And that's where the mortgage increase comes from. That's when, instead of them calling you and saying, hey, we've been collecting for $300 in your escrow account, but now your taxes and insurance increased, so we need you to send us up front right now whatever the increase is that's going to be remainder, whether it's $2,000 or whatever the case is. They don't say, hey, send us $2,000 so that at the end of the year we'll be set. They just add that extraness to your mortgage payment. So your payment increases $200, $300, or whatever the case is, so that they can be prepared at the end of the year to pay your taxes and insurance. One thing you don't want to be late on when you own property, or one thing you don't want to owe, is property taxes. There's a whole, that's a whole discussion for a different time. But you don't want to be late on your property taxes. That gives others the opportunity to pay your property taxes, and that can spiral out into something real bad. But that's why mortgage companies take that so serious, and that's why they also even give you better interest rates when you do escrow. Sometimes people think, yeah, I'm putting 20% down. Why did the 5% guy get a better interest rate than me? It's because you were escrowing. They like to see, and they like to know that the taxes are getting, they like to be in charge of the taxes and insurance, because it's so important to pay at the end of the year. So if you opt out of doing an escrow, let's say if you had 20% down, you did it, and you said, hey, no, I'd rather just pay that by myself, they're gonna give you a higher interest rate because it's more riskier to them if you're paying it themselves and if they just have no clue if you're paying it or not. But yeah, needless to say, common misconception that we get all the time is, if you rent, your landlord can increase your rent, but if you own, your mortgage stays the same for 30 years. Common misconception that's furthest from the truth. And never forget, your taxes, your principal and interest will stay locked for 30 years. If you're a first-time buyer and you're getting locked in on a 30-year mortgage, yeah, your principal and interest will stay the same. But if you're paying taxes and insurance as part of your monthly payment, and the county comes, they say whatever, the county comes and there's a new mall being built up the road, or whatever the case is, and the county needs more, they're going to increase your property taxes, and that's part of your mortgage payment. Your mortgage payment is going to increase. So just always prepare for something like that. Expect it. That's the whole point of this. Whenever you see your mortgage, it's part of home ownership. There's also a ton of things that are part of home ownership that people don't expect. Maintenance, pipes, things. That's why it's important to have homeowners insurance. But besides that, we're going to stay on topic, and I'm discussing mortgage payment increases. It happens even if you're on a 30-year fixed mortgage by way of your escrow account. All right, I hope you guys find this information of value. It's the Mortgage King, so you know who said it.